Why everyone expects a U.S. stock market crash, but the market keeps going up over the past several months. If you've been watching the U.S. stock market, you've probably noticed something strange. Bad news is everywhere. Experts keep predicting a crash, but the market keeps rising, not just a little, but strongly, consistently, and unexpectedly. So what's going on? Why are inflation, unemployment, war risks, government shutdowns, in the AI bubble warnings not dragging the market down? And is the market delusional, or is someone quietly pushing prices higher? Today we'll go deep into the real reasons behind this unusual rally. The last few years, constant fear of a crash from 2023 to 2025. Analysts, economists, and financial YouTubers all repeated the same message. The AI companies are in a bubble. The market will crash soon. This rally is a trap. And honestly, they have plenty of reasons to worry. Major negative factors hanging over the market. 1, inflation is down but still above the Fed's target. 2, unemployment has ticked up slightly, a possible sign of economic weakness. 3, geopolitical tensions and war risks remain high. 4, U.S. national debt has exploded to record highs. 5, the constant threat of a government shutdown shakes confidence. 6, high interest rates continue to pressure companies, real estate, and banks. 7, and most loudly, fears of an AI bubble burst. Many investors believe AI stocks, from chips to cloud to data centers, are overvalued and unsustainable. Some even call it .com 2.0. But regardless of
Why?
all these warnings, the market keeps climbing. So the big question is, who's buying? The market rises because of who is buying. The simple answer, institutional money, smart money. Over the last couple of months, massive capital from pension funds, hedge funds, sovereign wealth funds, investment banks, large asset managers has quietly flowed into the market. No hype, no media coverage, no emotional commentary, just silent accumulation. And institutions don't buy a few thousand shares. They buy millions. That alone can push the entire market up, even when retail traders are fearful and staying out. But here's the real question. Why are institutions buying when everyone else expects a crash? Reason number 1, institutions are pushing prices up to sell later. Not every big buyer believes in a long-term bull market. Many institutions are executing a classic strategy: pump, then dump. They accumulate when most retail traders are scared, because retail fear equals lower prices equals easy accumulation. Then they push the market higher through coordinated buying. Once prices reach attractive levels, they start distributing, selling to the late buyers, usually retail. It's a pattern as old as Wall Street. Institutions always move first, often months ahead of retail. Reason number 2, the Fed is paused, and that feels like a relief. Even though rates are still high, the Federal Reserve recently signaled that further rate hikes are unlikely, and that alone is enough to push markets up. Why? No more rate hikes equals companies breathe easier. Real estate gets a bit of relief. Leveraged funds feel less pressure. Investors hate uncertainty, and a pause reduces uncertainty. When the Fed stands still, the market feels temporarily safe, and that's when money returns. Reason number 3, the AI bubble may be real, but it's not bursting yet. Many people say the AI bubble will burst soon, but institutions understand something important. A bubble only bursts when expectations are extreme and new money stops flowing. Right now, big tech is still reporting real AI revenue growth. Governments and corporations are pouring billions into IT. NVIDIA, Microsoft, Amazon, Meta, Google continue massive investments. AI chips and data centers are still in extreme demand. So even if valuations are high, growth is real, and that delays the collapse. Institutions are exploiting that window. Why do so many people still believe a crash is coming? Because retail investors react to news, while institutions react to money flows. Retail sees CNBC headlines, YouTube videos, analysts predicting doom, social media panic, but institutions see order flow, ETF inflows, liquidity conditions, short-long positioning, bond yield dynamics, sentiment data. When retail is scared, institutions see opportunity. And historically, the market rises exactly when most people are afraid to enter. The market always moves opposite of the crowd. The stock market rarely follows popular emotion. As history shows, .com, 1999. Everyone was euphoric, market crashed. 2009, everyone terrified, market soared. COVID 2020, crash lasted only 1 month, then explosive bull run. 2023 to 2024, fear of AI bubble, market hit new highs. The market's job is to surprise the majority, and it does that extremely well. How long will this upward move last? Will a crash happen? This is the most important question. There are three realistic scenarios. Scenario one, a sharp crash in 30 to 40% after this pump. This happens if the Fed raises rates again, inflation spikes, AI revenue disappoints, geopolitical conflict spreads, liquidity tightens sharply. If a crash comes, it will be big because markets are being lifted artificially. Scenario two, a moderate correction, 10 to 15%, then another rally. This is the scenario many economists expect. The market cools down, removes some excess speculation, then resumes upward because AI growth remains massive. The Fed may cut rates later. Government stimulus could return. The U.S. remains the safest global investment destination. Scenario three, no crash, a continued multi-year bull run. This happens if rates start dropping, AMI spending accelerates, corporate earnings explode, government supports the economy, global capital keeps flowing into U.S. equities. It sounds unlikely, but it's absolutely possible. The truth, we are in a late cycle rally. Veteran investors call this the final stage of the cycle. Prices go up. Bad news is ignored. Retail stays out. Institutions paint the tape. Warning signals appear, but price keeps rising. Late cycle rallies are often the strongest, but also the riskiest. So what should investors do? 4 essential rules. 1. Don't FOMO. Buying at euphoria is how retail gets trapped at the top. 2. Don't be blindly bearish. Bad news does not guarantee a crash. 3. Follow money flow, not emotions. The market doesn't care about fear or hope. 4. Maintain discipline. Cut losses, take profits, and pick strong companies. Final message. The market follows money, not news. Most people believe the AI bubble will burst. The economy is weakening. The market cannot go much higher. But the reality is the market moves in the direction of those who control the money. And right now, they're buying. They know retail investors are scared, uncertain, waiting for a crash. And that's the perfect time to lift prices. But when retail finally starts believing, finally jumps in, finally FOMOs at the top, that's often exactly when institutions begin selling. So what do you think? Will a crash happen? Thanks for watching, and please drop your thoughts in the comments below. And don't forget to like, subscribe to MMS channel, and hit that notification bell so you don't miss our next deep dive here on Money Matters Smart. Because in the world of money, staying smart is what truly matters.